Hey, so in this video, what I want to do is do that other trick, the other tool that's in the financial analysis spreadsheet file. Okay, so again, you can grab the old one or you can grab a brand new one from the very top of our syllabus, right? So it's where you did step one. It looks like this. So you'd fill in your information and it would give you your ratios down below, or at least like the most critical ratios, right? But it's a file down here called valuation data, because that's step four and so kind of 4, 5, 6, 5 is right where you look at what is the stock worth. Sure, you've done the analysis, you've seen if it's a great and wonderful and healthy and safe company, but is it worth buying right now? Is it too expensive, or is it super undervalued, right? And for a long-term investor, this helps you get a much bigger picture than you can often find with a quick Google search, or even like you go to a Yahoo Finance, they'll give you some valuation like right now, but sometimes seeing the longer-term trend is really helpful. So to do that, you have to know how to use this tool. And sometimes you have to adapt it a little bit. So I'll go through it because it depends how much data for how long you're using it. Okay, so let's start by deleting all the data that's in it, which is for Apple. So bear with me because the internet might decide it's really slow. So if you have an older version of the file, it did not go down to row 3500. So you might need to add some more rows. And if you do that, over here on the right, there are formulas in these white cells that you will then need to expand. So that's very easy. All you have to do is highlight them, highlight the two, and then with the little sort of blue box in the corner, you can grab that and copy it down. And you need to copy it all the way down. And the fastest way is just to highlight and go, Control C, and then highlight all the way down as fast as you can, and just go Control V to paste, and it'll say, hey, you're not supposed to change this. If you're doing what I just showed you to do, then it's fine because you're just copying the formulas that are supposed to be there everywhere. So click OK, and the next thing you have to do to create the chart you want to look at is you have to get stock price data over many years, and you have to get earnings per share for the company, and we're working on Kiara, right? So to do that, you need to go to Kiara's website. And the reason you need to go here is to see how many years of data you can find. You might want to do less than actually is available, or maybe there won't be that much available. But in this case, these ones go to 2015. And if you click archived reports up there, you'll see it actually goes back even farther to 2010. And it really doesn't take that long. We just have to open it up and find earnings per share data. So I'll give you an example. So for the year 2010, our year-end report is right here. If I click that, what I get is this. And if I go, you need to scroll all the way down until you find the financial statement. So let me pause recording and I'll get there. So here we are. And here's the statement. You can see that it has 2009 and 2010, which means you actually only need every other year. I should have gotten 2011, and it would have had 2011 and 2010. I didn't really need to even open this one. But you can see down here the diluted earnings per share. If you look, can you see? If not, I'll erase myself, is $1.81, right? $1.81. Okay, so what do I do with that? Well, you put it here in this column, the earnings per share column. But first you have to get the price data. So I'm going to put that at the top, $1.81, just so we remember it, because it's the same process all the way down. I'm not going to show you the whole thing. I'll just start it and then show you when it's done. Okay, so the next thing you have to do is you need to go to Yahoo Finance. And you need the historical price data, right? And you'd put in, so for Kiara, you go back to December. So I put in 2010, December 30th or 31st. And we can go right up to just a couple of days, like the day before this video was recorded, right? We can grab it all. When you click done, don't forget to hit apply. And once you hit apply, you click download, and it's going to grab all that data. And so what you do with it is you can open it in Microsoft Excel if you've got it, but if not, don't worry. You can just upload this file that downloaded down there is a CSV file, comma separated values. You don't even need to know what that means. Just upload it to your Google Drive and try to open it, and it'll give you the option of opening it in a Google spreadsheet. And then from there, you can just copy and paste it over. So I'm going to pause the video again, and you'll see. Actually, I changed my mind. Just in case you've never done this before, we're going to upload it. So I'm going to go new, and it's going to be a new file upload. And I'm going to grab what I just downloaded, which is my Kiara CSV file. And so it's uploading, and as soon as it uploads, I'll click on it, and it'll give me the option of opening it as a Google spreadsheet. So if I click this now, it says open with Google Sheets. So I'll click it, and it's going to take a couple seconds to convert it. And once it's there, all you really need are the dates and the closing prices. That's it. So here it is. I'm going to just quickly highlight column B to column D and column B to column D. And I'm going to right click, and I'm just going to make this easier, and I'm going to delete those columns. Then I'm going to write my memoirs while the internet catches up. Oh, here we go. And then all I'm going to do is grab all of these and these because that's my closing prices, right? Okay. I'm going to go Control C, and then I'm going to go to our tool, and I'm going to plop them right here in row 2. Right? So I'm going to have my date, and I'm going to have the closing prices, and then all I have to do is go through those annual reports and grab the diluted earnings per share, and I put them at the year end for each year. And Kiera, if you don't know this, you can find it right from its reports, right? For the period ending December 31st. So their year end is December 31st. So you're going to put the earnings per share for example, this one up on the screen is 2019. So you'd put its earnings per share for 2019 on December 31st, 2019, whatever row that is on, which would probably be very close to the end. That was silly me. We only went to 2019 instead of 2020. So I'm going to grab the rest of the data, and then I'll show you what to do with the earnings per share. Okay, so I fixed my boo-boo, and now our data, as you can see, goes to April 24th, 2020. All right, so what do you do then? Well, as you can see in the white, the numbers have populated where we have data. We just need to go back now and put in our numbers. So here was the end of 2010. Actually, that can go the next day. $1.81. Wonderful. Doesn't really matter that much. So next, 2011. Grab that data. And so here's the annual report from 2012. So in the income statement, you'll have 2012 and 2011. So let's go find it. Here we are. Here's the income statement. So you got 2012 and 2011. Down at the very bottom, you got diluted earnings per share of $1.71 in 2012 and $1.90 in 2011. So you're going to use those numbers in your tool. So $1.90 first. So if we go back to the analysis tool, the end of 2011, so you'd scroll down to December. Here it is. December 30th was the last trading day, and that was $1.90. I just realized this needs to be here. Close enough. It's off by a day, but that's fine. Okay. So when you do your first one, make sure it's on the very top row. I forgot about that little trick. So then you go down to the end of 2012. Down we go. End of 2012. Scrolling. Killing video time. Here we go. And you would put in earnings per share for 2012, which was $1.71. And once you've done that, for the year end of all the years you have, you'll be finished. So I'm going to pause the video and do that so we don't kill more of a digital video. So if you look, I've got all the dates and the last earnings per share, which is what we've been working on with the end of 2019 on December 31st. I put it in for $2.07 a share. That's the diluted amount. But I didn't stop. Notice I did something else, and I'll explain why in about 4 seconds. I kept the dates going. Right? And I kept the prices going to sort of what time it is right now. It's late April, right? And then I kept the dates going past price data, so into the future. In fact, I went, how far did I go? I went all the way to the year 2023. I guess I don't need to go that far, but I did go right to the end of 2022. So to the year end again, right? The end of the full year 2022. And here's why. Because this is what, if you did everything I've shown you, you're going to get a chart that looks like this. And you don't want it to cut off kind of right here. You want to see what are the future projections. And if we go back to our syllabus, that's kind of how you can use this thing right here, this earnings projections. And you can find it for free on the internet, but I grabbed this one from my broker's account, so why not? Or one of my broker's accounts. So it's TD Waterhouse. So you see over here, the annual reports tell you earnings per share that actually happened. This is projecting what it will be. And you could use the current average. So I plopped in these averages. So this is the earnings per share. It's the current average of all the analysts. There's almost 20 analysts following this company around the world. So 20 of them have come up with an average earnings per share of each of these amounts in those years. But the lowest estimate, so if you want to be really conservative, you could actually just use the lowest analyst's report. I say, so the worst case scenario, the worst of those 20 analysts is saying this company is going to make $1.31 a share. That's profit, by the way. So the worst case scenario, the worst analyst, the most negative analyst still says this company is going to make profit. FYI. So you could use those. I'm going to use the average. So that's all you really need from the sheet for right now. And I plop those in. So in our valuation data, I've got those numbers at the end of each of those future years. I actually don't think I did the first 2 or 3. But that gives you this image, right? The red dots are earnings. And you got a little trend line in there that you can choose to ignore or even change to a different type of trend line. So like a exponential trend line, a straight trend line. You just right click and you can muck around with it. But the red dots, and remember those numbers, the numbers on this chart are not dollars. They're how much bigger or smaller the stock or the earnings were from the very first data point. So the very first numbers are 100, and then everything else is a percent difference. So this one way up here at the top for stock price is 282% of the starting stock price. So it got ahead of itself. Way ahead. Earnings came in. You had this oil crash in 2016. Stock kind of stayed flat because, a lot of their business is transporting it. So the price of the product isn't as important to Keyera. And then kind of falling over the edge, coming down, just as earnings were coming up. Kind of wild, eh? So giving you an indication, this might have been an undervalued company. Maybe there were other problems. And then now this, right? So earnings coming in, and then they're expected to rise after this sort of hiccup in the next 2 years. But compared to where the red dots have been and the blue line stock price has been, you're in a situation that hasn't been in the last 10 years, except maybe like 2010, 2011. But even then, the stock price was kind of keeping up with earnings per share growth. Now it's well below, right? So this is a tool that gives you a big picture in terms of the types of things that successful investors like big names like George Soros and Warren Buffett, the types of things they do. They look for good companies and they look for them when they're undervalued, right? And this is a way to decide over the long run if they're undervalued or not. And Keyera right now, assuming of course everything is correct and all the projections are true and they're going to pan out, Keyera is under the trend line. Right? It is undervalued by definition. So if it's a healthy company and it's safe and it's liquid and it's solvent, it's hard not to look attractive. Right? And that's true of any company in similar situations. So that's how you use this tool. So when you become a long-term investor, these are the types of things you need to think about. It's very difficult to lose money on a well-run company in a good situation that's undervalued this much. Here's another way to look at this. If I were to buy the stock today, what would I be paying for? And one of the ways we look at valuation is how much am I paying for $1 of profit a share? But there's another way too to think about it, especially if this company gets like so utterly like. Remember, euphoria can drive a stock too high, too quick, like it was way back there, right? Way back there. In what year was that? About 2014, 2015. Way like earnings were falling, stock was rising. Crazy, right? But it can go the other way, like this panic that it looks like we're at right now, where it's gone. Meanwhile, it looks like earnings will, hit a trough, but then head back up. Another way to look at it, and so keeping that in mind, when things get really crazy, there's another way to think of value in terms of how much is the company's equity per share, right? So in other words, if you take your assets and you believe they're fairly valued and you take away the liabilities, all that equity that's left, that's for you, the owner. In other words, the shareholder. So how much is that per share? Because sometimes companies get so brutalized that the stock price is almost equal to the book value per share. And a book value is an accounting value. It's not market value. Essentially, if you, for example, if the book value per share is $5 and the share is going for $5 on the market, you're essentially getting all future profit for free. Because if a company can make profit, then its book value, its equity is going to go up, because that's what profit is. It's increased to equity. So as the equity goes up, you've paid nothing to acquire future profits. This company, for example, is expected to continue to make profit, which means its equity should be growing. So how much of that future profit is included in the market price, right? The market, that's why the market price of a company's equity, right, which is what a stock is, ownership of the equity. So the market capitalization of a company is the market value of the firm's equity. So when they're the same, you know there's a problem if it's a profitable or likely to be profitable company, because you are essentially paying nothing for all future profit that will increase the equity. So let's just quickly take a look at that. So I just grabbed the most recent annual report again, and we look. Let's go here first. So here's the balance sheet. So if you go down, total equity at the end is $3 billion, right here, right? $3 billion. So I'm just going to grab a spreadsheet. Let's put that in. So the equity is $3 billion, and we'll say that's in millions. It was 30-50, but who cares? Whatever. So $3 billion, $50 million of equity. Shares, you often can find that. Sometimes it's right in the balance sheet. It's almost always in the notes, and sometimes it's in the fourth statement we don't really learn about, but I found it in note 20. So there are 218 million shares. So these are in millions. So let's go 217.9, I think it was, wasn't it? Oh man, do I have no memory anymore? Where was it? 217.9. Okay. That's how many shares. So what's the book value? In other words, the equity per share is this divided by this. What do we get? $14. $14 at the end of 2019. Do you see our data? Look at our valuation data. Let's go back to where there's actually numbers. Right here. What happened to the stock? So at the year end, it was $34 a share. And panic set in. And where did it get to? It got to $10.48. That's less than the equity per share. Now, of course, this is 2 months into the next year, but surely they didn't lose $4 a share in that period of time. You know, when a stock's market price is less than its equity per share, its accounting numbers per share, come on, you're essentially paying nothing for all future profit. It's a no-brainer. So that is essentially the idea, right? Find a company, a good one that's undervalued, go with it. So the purpose of this was to learn why you would do this and how to use it, but most importantly, how to do it yourself for the first time. So use this video to try to complete what you have just seen me do to make sure you know how to do it. That's it. Good luck.